JPX Energy Market Weekly Updates. Benchmark crude oil prices edged higher on the last trading day of 2022, with JPX Dubai and IC Brent hovering around the highest level in 2 weeks and catching up with a rally in commodity prices spurred by China's move to reopen its borders, further unwinding its COVID controls. Intermonth spread of major crude oil benchmarks, however, has shown some divergence, with IC Brent first-month and third-month spread rally to recent highs, while JPX Dubai and NYMEX WTI showing some weakness. Risk of market corrections remains recently. Spikes in China's COVID cases once weigh on market sentiment. The epidemic has caused a sizable impact on supply and demand for manufacturing companies, reduced employee attendance, and disrupted logistics. According to data released by the National Bureau of Statistics, China's official PMI fell to 47 from November's 48, missing expectations. But according to our observation and local survey reports, with the number of infections rapidly reaching a peak level and as people recovering from illness, mobility is rebounding faster than previously expected. This could be observed from the indicator of subway passenger volume as well as traffic congestion index of major cities in China. This is offering hopeful signs for the broader recovery of social and economic activity. What's more, China has finally decided to remove some of its most stringent travel restriction measures, starting from January 8, 2023. Among other changes, China will no longer conduct nucleic acid tests and centralized quarantine for all inbound travelers, and measures to control the number of international passenger flights will be lifted. There have been signs of upward moves in product markets as well, with middle distillate cracks responding positively to the news. Jet demand has proven particularly resilient, with the spread of kerosene and 10 ppm diesel at its highest since 2019. The IEA expects global use of jet kerosene to increase by 13% next year, outpacing demand growth for any other refined oil product. On the supply side, possible disruption to Russian export was also lending support for oil markets. Based on analysis of data from Kepler, in the first 3 full weeks of December, Russia exported approximately 50 million barrels of its own crude via the sea, compared with 67 million barrels in the same period in November. The news of Russia will ban oil sales to buyers complying with the G7 price cap, on the other hand, had little effect on prices, largely because Russia's response was anything but surprising. All eyes will be on February the 5th, as EU embargo on Russian petroleum products and price cap comes into effect. Europe rely heavily on Russia for diesel, and the supply chain caused by the halt of Russian imports will be significant. Redirecting oil products will be more difficult than crude, since China and India also export petroleum products. These volumes probably need to be diverted to smaller markets in Africa and Latin America. Russia says it may increase its crude oil export if the European Union ban on imports of the nation's fuel result in lower refinery throughput. What's more, the preliminary guidance on the implementation of the price cap policy for petroleum products of Russia released by the United States last week grant exemption for Russian petroleum products from the price cap once Russian crude oil are substantially transformed outside Russia. As the oil product embargo comes into effect, Russia is likely to export more crude oil to Asia, while Europe is likely to import more oil products from Asia. The competition for non-Russia diesel barrels will be fierce, with the EU countries having to beat cargoes from the United States and Asia away from their traditional buyers. If this results in European diesel prices increasing at a faster pace than jet fuel values, it will incentivize local refiners to maximize diesel yields at the expense of jet fuel. Foreign margins from middle distillates overall will supply global refinery runs. With Europe becoming more reliant on middle distillate imports from markets east of Suez, another factor that could weigh on supply in the region next year is the cost of freight. Despite the price mechanism allowing Western companies to continue to underwrite such cargoes, it has become harder for shippers to get some types of insurance. Global protection and indemnity insurers issued amendments on December 23rd for certain policies, including charterers' liability cover, excluding losses coming from the conflict or an expansion of it. Since the war began in February 2022, the geopolitical uncertainty has driven up insurance premiums, blowing clean tanker rates towards record highs for the majority of the global routes. Okay, that's all we have for this week. Welcome back next week.